Welcome to Law Days Lattes, the podcast where we blend the world of law and business with a warm cup of information and common sense. I'm your host, Sidney Whelan, attorney, real estate investor, and business owner. Each week, we'll be your go-to source for legal insights, business advice, and so much more. Whether you're a seasoned professional, an ambitious entrepreneur, or simply someone seeking guidance, we'll have you covered. From navigating the legal landscape to empowering you with valuable business strategies, we'll explore the legal side of life and enjoy a virtual latte along the way. So, grab your favorite latte, get comfortable, and let's dive in to Law Days Lattes. Welcome back to Law Days Lattes, the podcast where we talk about law, business, wealth, and legacy in a way that actually makes sense. I'm your host, Sidney Whelan, founder of the Whelan Law Firm, serving North Central Missouri businesses and families in 3 convenient locations, Moberly, Carrollton, and Paris. Today, I want to talk about something that completely changed the way you think about building wealth. One of the biggest misconceptions I hear is, I'd love to buy that property. I'd love to start that business. I'd love to make that investment, but the bank won't loan me the money. Well, maybe that's true. But here's the question I want you to ask. Is a bank really the only option? Because sometimes the answer is no. There are a lot of creative ways to finance a real estate transaction, a business, or another major purchase that don't necessarily involve walking into a bank and asking for a traditional loan. Today, I want to talk about some of those possibilities. Now, before we get started, let me give you the disclaimer that I always give when we're talking about financial or legal strategies. This is for educational purposes only. Every situation is different, and many of these strategies have legal, tax, and financial implications. You should talk with your attorney, your CPA, your financial advisor, or other appropriate professional before implementing any of them. And with that said, let's start thinking outside the box. Think like a problem solver. One thing I've learned over the years is that successful investors don't just look at a property or a business and ask, can I afford this? They ask, how could I make this work? That's a very different question. Sometimes the challenge isn't finding the right opportunity, it's finding the right way to pay for it. And there may be more options than you realize. Let's talk about some of them. First, owner financing. This is one of my favorite creative financing strategies. Owner financing. Instead of going to a bank, the seller actually becomes the lender. Maybe the buyer makes a down payment. Maybe the seller finances the balance. The parties negotiate the interest rate. They negotiate the payment schedule. They negotiate whether there's a balloon payment. They can negotiate all sorts of terms. Now, that doesn't mean you can simply write whatever you want on the back of a napkin and call it a loan. These transactions need to be properly documented. You need to understand the legal and tax consequences, but owner financing can be a creative win-win situation. Maybe the buyer doesn't qualify for traditional financing, or maybe the buyer just needs more flexibility. And maybe the seller doesn't need all of the money immediately. Perhaps the seller would actually prefer a stream of monthly income payments. So instead of one party saying, the bank won't loan me the money, and the other party saying, I can't sell because the buyer can't get financing, you start asking the question, is there a way we can structure this transaction so it works for both of us? That's creative financing. Exactly how does the owner financing work? One thing I do not recommend is something that used to be quite popular, a contract for deed. Basically, a real estate contract that allows the buyer to pay the owner periodic payments with an agreement that the deed will be issued when all of the payments are made. Do not do this. Let me say it again. Please do not do this. So many things can go wrong, and it's usually the buyer who loses. What if the seller dies before the deed is issued? What if you and the seller disagree on how many payments were actually paid? Who takes the hit if there is damage to the property before the deed transfers? The better way is to transfer the property by a deed with the buyer signing a promissory note and a mortgage, or in Missouri, a deed of trust that is recorded, giving the seller a security interest in the property. The buyer gets possession and title to the property at closing. The seller is then protected if the buyer defaults. Again, be sure you work with professionals so that everything goes as planned. There's another financing opportunity that I want to talk with you about. Self-directed IRAs. What is that? A lot of people think of their retirement account as money invested in stocks, bonds, mutual funds, or similar investments. But there are retirement account structures that may allow investment in alternative assets, including real estate. You may have to do your due diligence to find a company that handles the self-directed IRAs, but a properly established self-directed IRA can, in certain circumstances, invest in real estate. Why might this be an opportunity for you? Take the example that one of my clients experienced. A piece of farmland became available for sale. This land was in close proximity to land they already owned. The problems? Well, the clients were short of cash, and there were no buildings or structures on the property. A bank loan did not make financial sense. Although there was some income potential from the property, it was not enough to justify the high interest rates, and the loan payments would not have been feasible for my clients. However, these clients had liquid assets sitting in a traditional IRA invested in stocks at a time when stocks were not doing particularly well. However, pulling the cash out of that IRA would have resulted in taxes and penalties that my clients did not want to incur. The solution? Move part of the traditional IRA to a self-directed IRA and purchase the property through that IRA. The self-directed IRA holds title to the land, and any income from renting the property goes directly into your IRA, increasing the value of that portfolio. Now, this is an area where you really need professional advice. There are very specific IRS rules. There are prohibited transactions. There are restrictions regarding who can use or benefit from the property. And you cannot simply take money out of your IRA and use it however you want, without potentially triggering taxes and penalties. Stay tuned to a future episode where I will go into more detail about self-directed IRAs, both the pros and the cons of this type of investment. But the larger point here is this: your retirement account may have more investment flexibility than you realize. If you're interested in using retirement accounts to invest in real estate or other alternative assets, learn the rules first and work with professionals who understand this very specialized area. Next, borrowing against retirement funds. There may be circumstances where someone can borrow against certain employer-sponsored retirement plans. Again, this depends on the specific type of plan and its rules. And this is another area where you need to understand the downside. You certainly don't want to jeopardize your retirement security in an effort to make an investment today. But if you're looking at a financing problem, don't automatically assume that every dollar in your retirement account is completely inaccessible. There may be options. Just make sure you understand exactly what you're doing before you use them. Let's talk about something else. Family financing. Proceed with caution. Now, I want to put a big caution sign next to this option. Borrowing from family. I've had my own experiences with lending money to family, and I will tell you this from experience. I would make family borrowing one of my very last choices. Sounds wonderful in theory. You have a family member who needs money. You have the ability to help. Maybe they can't get traditional financing. Maybe you believe in what they're trying to accomplish, and you think, we're family, we can work this out. But here's what I've learned. Money has a way of changing relationships. And when a family loan goes bad, and sometimes they do go bad, the problem isn't just that somebody didn't make a payment. Now you're dealing with Thanksgiving dinner, Christmas, family gatherings, birthdays. And every time you see that person, there's this unresolved financial issue sitting in the room with you. It can damage relationships that may be impossible to repair. So, if you're considering lending money to a family member, my first advice is think very carefully before you do it. And if you decide to move forward anyway, treat it in every respect like a business transaction with a complete stranger. Put it in writing. Have a promissory note. Establish the interest rate. Establish the payment schedule. Document what happens if payments aren't made. Don't rely on a handshake or a hug just because you're family. In fact, I'd argue that being family is an even greater reason to document that transaction carefully. And there's another piece of advice I've heard over the years that I think is incredibly wise. Only lend a family member money that you could afford to give them. In other words, if you're lending your sister $50,000, ask yourself, if she never pays me back, can I honestly live with that? Because if the answer is no, if losing that money would create a financial hardship or resentment, you probably shouldn't make the loan. Think about the money as though it were a gift. You don't have to actually call it a gift. You don't have to give up your right to be repaid. But you need to understand your own mindset before you make the transaction. Because if the worst happens and you never see the money again, you have at least protected yourself emotionally from allowing that financial loss to destroy the relationship. And if you're the borrower, honor your side of the bargain too. If you make a promise to pay, pay. Communicate when there's a problem. Don't make your family member chase you for the money. And don't assume that because they're family, the rules don't apply. Creative financing should create opportunities, not create family casualties. So my advice is simple. Family financing can work, but don't enter into it casually. Think very carefully. Document everything, and never lend more money than you can afford to lose. And then there's another situation. It's the cosigner. That's another financing arrangement that I want to put a big caution sign next to. Co-signing a loan. This is another one where I would be extremely cautious, particularly when the person asking you to co-sign is a family member or a close friend. You may think you're simply helping someone qualify for a loan, but that's not really what you're doing. You're taking on a debt obligation. When you co-sign a loan, you can be responsible for the debt if the primary borrower doesn't pay. And you're taking on that obligation without necessarily having any control over the asset that the money was used to purchase. Let's say your son or daughter wants to buy a piece of equipment, or a vehicle, or a house, or perhaps they're starting a business and need financing. They don't qualify on their own, so they ask you to co-sign. You think, I'm not really borrowing the money. I'm just helping them get the loan. Be very careful with that type of thinking, because if things go wrong, the lender may look to you for a payment. And here's the part I think people sometimes fail to consider. You may have the debt without having the asset. The person you helped may have possession of the house, the vehicle, the equipment, or the business. They may be making the decisions. They may have control of the asset. But if they stop making loan payments, you will still be responsible for the debt. And now you're potentially paying for something that you don't own and don't control. That's a very different proposition than simply helping someone. There can also be consequences to your own financial life. A default can affect your credit. It can affect your ability to qualify for your own financing. And, depending upon the loan and the circumstances, if you pledged collateral or otherwise guaranteed the obligation, you could put your own assets at risk. So, before you ever co-sign a loan, ask yourself this question. If this person never makes another payment, am I financially and emotionally prepared to make every payment myself? Because that's the scenario you need to be prepared for. And I would take it one step further. Before you co-sign, ask, if I had to make every payment on this loan myself, would I still be willing to do it? If the answer is no, think very carefully before signing. And remember, love is not a substitute for due diligence. You can love somebody tremendously and still say, I love you, but I can't take on this financial obligation for you. That's not selfish. That's being responsible. Sometimes the most loving thing you can do for a family member is to help them find another solution rather than putting your own financial security at risk. Read the documents, ask questions, understand exactly what you're guaranteeing. Know what collateral is involved. Understand what happens if the borrower defaults. And most importantly, never sign something simply because someone you love asks you to do so. Creative financing is about finding solutions, but it's not about transferring someone else's risk onto your own shoulders without understanding it. Now, let's talk about another possibility, using assets you already have. Maybe you have a certificate of deposit, a CD. Maybe you have an investment asset. Maybe you own equipment. Maybe you have some equity in real estate. Sometimes those assets can be used as collateral to obtain financing rather than selling the asset. That can potentially allow you to preserve the underlying investment while creating borrowing power. Again, there are risks. If you pledge an asset as collateral, you need to understand what happens if you don't repay the loan. But the point is to look at your entire financial picture. Don't just ask, how much cash do I have? Ask, what resources do I have? Those are two very different questions. Now, grants and small business loans. If you're starting or expanding a business, don't forget to look at grants and small business lending programs. There are programs designed to help encourage economic development, support small businesses, promote rural development, assist particular industries, and encourage entrepreneurship. Not every program will apply to every person, and grants aren't free money that everyone qualifies for. But too many people never investigate because they assume they won't qualify. You may be surprised, so start looking. Talk to your local economic development organizations. Also, in our area of North Missouri, the Mark Twain Regional Council of Governments has tremendous resources available and provides support services and programs to the counties and communities within an 8-county area of Northeast Missouri. Talk to these people. Talk to lenders. Talk to other people who specialize in helping businesses identify available programs. Sometimes the money is there. You just have to know where to look. Another creative option is partnerships, bringing in a partner. Maybe you have the idea, but not the money. Someone else has the money, but doesn't have the time or the expertise. Maybe someone has property. Another person has the business experience. Another person has the relationships. Sometimes combining resources can make an opportunity possible. But here's where I want to emphasize something I've said before. Get it in writing. Friendships are wonderful. Family relationships are precious. But when money and ownership are involved, you need clear agreements. Who owns what? Who contributes what? Who's going to make the decisions? How are profits to be divided? Who is going to be responsible for losses? What happens if someone wants out? What happens if somebody dies? What happens if somebody stops doing their part? The time to answer all of those questions is before the money changes hands, not after there's a disagreement. Sometimes creative financing isn't really about borrowing money at all. It's about negotiating the transactions. Could the seller pay some of the closing cost? Could the purchase price be adjusted? Could the seller provide a credit for repairs? Could part of the transaction be delayed? Maybe it doesn't all have to be done at once. Could the parties negotiate different payment terms? Could the transaction be structured differently to accommodate both sides? When you're negotiating a transaction, don't assume that the first proposal is the only possible solution. Ask questions. Find out what the other party needs. Sometimes you can solve a financing problem simply by structuring the deal a little bit differently. The bigger lesson here. Here's what I really want you to take away from today's episode. Don't stop at "the bank said no." Instead, start asking better questions. Who has the problem I'm trying to solve? Who might benefit from this transaction? What resources do I already have? And what assets could potentially be used? Could the seller finance it? Could there be a partner? Are there grants or other programs available? Are there alternative investment vehicles? Is there another way to structure the transaction? But, and this is a very important but, creative doesn't mean careless. Just because you can structure a transaction differently doesn't mean you should. Every financing arrangement transfers risk. The question is who is taking the risk, and do they understand it? That's especially important when the other person is your parent, your child, your sibling, your best friend, or someone you love. You don't want creative financing to become creative ways of destroying relationships or putting your own financial future at risk. Build it, protect it, pass it on. This is really where today's conversation comes back to the philosophy I talk about all the time. Build it, protect it, and pass it on. Building wealth sometimes requires creativity. You may have to think differently. You may have to negotiate. You may have to find capital in places you didn't realize existed. But once you build something, you have to protect it. That means understanding your obligations, understanding your risks, putting things in writing, and getting good advice, and thinking about what happens if things don't go according to plan. Because the goal isn't simply to acquire an asset. The goal is to build something that lasts. And ultimately, that's what we're talking about when we talk about legacy. You're not just talking about what you own. You're talking about what you build, how you protect it, and what you're able to pass on. So, some final thoughts. Next time you find yourself saying, "I can't do that because the bank won't loan me the money," I want you to stop, take a breath, and ask a different question. What other options might exist? Maybe there aren't any. Maybe the deal isn't right. Maybe walking away is the smartest financial decision you could make. But maybe there's another path. And that's what creative financing is really about. It's not about finding a way to borrow money at any cost. It's about finding a smart way to accomplish a worthwhile goal while understanding and managing the risk. So be creative, be curious, ask better questions, and get good advice. Protect yourself and the people you love along the way. Thank you for joining me for another episode of Law Days and Lattes. And if you enjoyed today's conversation, I'd love for you to subscribe, leave a review, and share this episode with someone who's been told you can't afford it or the bank won't finance it. Maybe the answer isn't simply to give up. Maybe it's time to start asking better questions. So until next time, build it, protect it, and pass it on. Have a great week, my friends.
This podcast episode contains general information for discussion purposes only. Each case is different and must be judged on its own merits. Missouri rules generally prohibit lawyers from advertising that they specialize in particular areas of the law. This show should not be construed to suggest such specialization. Nothing on this show should be taken as legal advice for any individual case or situation. This information is not intended to create an attorney-client relationship, and the listening or viewing of this podcast does not constitute an attorney-client relationship. The choice of a lawyer is an important decision and should not be based solely upon advertisements.